Welcome to the latest episode in this series of EY videos on the implementation of the new Leases standard, IFRS 16, which has become effective this year. The objective of these short videos is to provide helpful reminders during the first year that IFRS 16 is effective, and to share with you some of the latest insights which could affect IFRS reporters. I'm Emily Moll, an Executive Director with the Global IFRS Services team at EY Global in London. In this episode, we will cover the key reminders and considerations about the implementation of IFRS 16 by lessees as calendar year-end entities finalise their annual financial statements. I'm joined by Victor Chan. Victor's an International Director at EY Global in London, where he's a member of EY's Global IFRS Services team, and among others, the Global Leases subject matter group. Victor, welcome. Thank you for joining us today.
Thanks, Emily. I'm glad to be here.
So Victor, can you spend a few minutes just sharing your key insights and considerations about IFRS 16 for year-end reporting purposes, starting with the definition of a lease?
Sure, Emily. Entities have spent a substantial amount of time and effort on implementation. One key issue is the identification of a lease. Entities need to determine whether the contract includes an identified asset and whether the customer has the right to control the identified asset for a period of time in exchange for consideration. Both can be difficult to do in practice, and in particular, the second issue may require significant judgment as entities need to consider who has the right to direct how and for what purpose the asset is used. This means entities need to determine who has the decision-making rights that affects the economic benefits to be derived from the use of the asset. This represents a significant change from the leases model under the legacy standard. A very important step in identifying a lease is to read the contract to ensure completeness. This is a practical challenge that entities had to tackle when identifying leases for transition purposes, and they still have to do so today for contracts signed or modified during the current year. Some entities have decentralized leasing processes which make data collection even more challenging. There could be leases embedded in a contract, so just because the title of a contract doesn't include the word lease doesn't necessarily mean that the contract doesn't need to be reviewed.
So that's helpful. So if we move to the next slide, Victor, what are the reminders here about lease term and lease payments?
Well, we won't have time to discuss every single point of these two concepts, so let's focus on the key issues. One of them is the situation when an entity enters into a lease contract that doesn't specify a particular contractual term and continues indefinitely until either party gives notice to terminate. In such a situation, it is necessary to consider the guidance in paragraph B34 of IFRS 16. We have reproduced the paragraph on the slide. At a very high level, what it means is that the lease term is capped at the point in time when the lessee and the lessor each have the right to terminate the lease without permission from the other party with no more than an insignificant penalty. I think it is important to emphasize that the term penalty is interpreted broadly to include economic disincentives, and the term enforceability is applied to the contract but not to the termination option. If the application of this paragraph doesn't result in a lease term limited to the notice period, then the entity needs to evaluate the lease term using the reasonably certain criterion. The IFRS Interpretations Committee recently published an agenda decision on this issue. We have issued an IFRS development, and our next video would cover this in more detail. If this is a fact pattern relevant to an entity, I would strongly recommend the entity to consider the implications of the agenda decision carefully. With respect to the lease payments, I think the most important reminder is that there are lease agreements that include payments that are described as variable or may appear to contain variability, but are in fact in substance fixed payments because the contract terms ensure that a payment of a fixed amount is unavoidable. Such payments are included in the lease payments at lease commencement and thus used to measure the entity's lease liabilities. To distinguish what is variable and what is in substance fixed, it may be helpful to evaluate whether the payments are genuinely variable. In some cases, this requires judgment.
So the next topic is the incremental borrowing rate, also referred to as the IBR. What's your key reminder, Victor?
Well, Emily, the key reminder is that the incremental borrowing rate is an entity-specific rate, and the lessee will need to make sure that its estimation of the IBR considers current market conditions. The lessee often starts with the general credit of the entity and adjusts for the security. Where applicable, the lessee also considers differences between the existing debts and lease terms and any difference in the underlying currency. In specific circumstances, a subsidiary might be able to use the IBR of the parent as a starting point. However, adjustments should be applied to account for any difference in facts and circumstances. And going forward, the inputs to this estimate, such as the lessee's credit rating or market conditions, may change over time and may affect the subsequent estimation of the IBR for new, reassessed or modified leases.
Your remarks on the accounting considerations going forward are helpful, and the next slide on the remeasurement of the lease liability is also about the ongoing application of the standard.
Yes, Emily. The slide provides a helpful summary of some of the common situations when the lease liability needs to be remeasured by a lessee. These situations include certain modifications, the occurrence of a significant event or significant change in circumstances within the lessee's control that affects the reasonably certain assessment, actual changes of lease term, the resolution of the variability of lease payments, changes in the expected amount payable when a residual value guarantee, as well as a change in index or rate. Under the first three situations, the lessee needs to use the updated discount rate to remeasure the lease liability. On the next slide, we have included other considerations on specific situations which may also be related to the interaction with other standards. We discussed in more detail in our previous video the interaction between the new leases standard and the impairment standard of IAS 36. We have not touched on the sale and leaseback transactions previously. There are two major requirements to bear in mind. The first one is that the transfer of an asset by the seller lessee needs to satisfy the requirements of IFRS 15, revenue from contracts with customers, to be accounted for as a sale of the asset. It is important to evaluate whether there is any repurchase agreement, as IFRS 15 may preclude a sale in these situations. If it is concluded that there is a sale, then the sale and leaseback transaction guidance applies. If not, the transaction is a financing transaction. The second key reminder is that the seller lessee recognizes only the amount of any gain or loss that relates to the rights transferred to the buyer lessor. The third main bullet point is about leases acquired in a business combination. IFRS 3, business combinations, has been amended such that the acquirer measures the acquired lease liability as if the lease contract were a new lease at the acquisition date. That is, the acquirer applies IFRS 16's initial measurement provisions using the present value of the remaining lease payments at the acquisition date. The acquirer measures the right of use asset at the same amount as the lease liability, adjusted to reflect favorable or unfavorable terms of the lease when compared with market terms. So the acquirer no longer recognizes any off-market terms separately.
So the next topic is about disclosure.
As with other standards, IFRS 16 focuses on an objective, which is to give users a basis to assess the effects leases have on financial position, financial performance, and cash flows. When we look at the lessee's disclosure requirements, they are organized around three groups. The first group is the more quantitative disclosures that are usually expected to be provided in a tabular format. They relate to both the accounting for the right of use asset, the lease liability, and the related income statement and cash flows presentation effects. The second group is related to those requirements that are applicable due to other standards. For example, for leases which meet the definition of an investment property under IAS 40, investment property. The last group could be the most judgmental. The standard notes that more information may be necessary on the nature of the lessee's leasing activities, future cash flows to which the lessee is potentially exposed to that are not reflected in the measurement of lease liability, restriction or covenants imposed by leases, and sale and leaseback transactions. A lot of the discussion today revolves around judgments. Judgments or sources of estimation uncertainty in relation to leases may become more significant for financial reporting after the adoption of IFRS 16, considering in some cases the major impacts to entities' financial statements. Regulators therefore expect entities to consider whether additional disclosure of judgments may now be required. A commonly identified judgment relates to lease extension or termination options. Some entities also disclose that the determination of the discount rate requires material judgment. So far, the observation is that the disclosures often lack granular entity-specific detail about judgments. There is usually very limited discussion on how the judgment has been reached and how it impacts on the financial statements. So entities may need to consider improving the disclosure related to judgment.
Thanks, Victor. And on the last slide, there are some reminders outside of financial reporting.
These are the final remarks for this video. The adoption of IFRS 16 may result in a material impact to the financial statements of an entity, especially for those in the airline, retail, shipping, and telecommunications sectors. These entities need to consider how IFRS 16 affects covenant ratios if they are not calculated based on a frozen gap. As a constant interest rate is applied to the lease liability, more interest expense is incurred in the early periods and less in the later periods. This trend in the interest expense, combined with the straight-line depreciation of the right-of-use assets, results in front-loaded expense recognition pattern. However, at the same time, as the depreciation of the right-of-use assets and the interest expense are often excluded from alternative performance measures or APMs such as EBITDA, the adoption of IFRS 16 often results in a higher EBITDA for the same period. Therefore, entities also need to consider how IFRS 16 may affect employee compensation based on these metrics. Of course, if an entity uses APMs to communicate its results with its investors, it would need to evaluate how to communicate the impact to the APMs in the first-year adoption of IFRS 16, especially if the modified retrospective approach is applied, as the prior comparatives are not restated. Last but not least, about systems, many entities have made significant investments with the development of new or upgraded systems, including processes and controls, to prepare for the adoption of IFRS 16. As practice develops and the interpretation of the guidance evolves, these systems may require updates, upgrades, or even the addition of new functionalities or reports in order to enable the entities to follow these practices. This means that entities also need to develop additional processes and controls necessary to address the risks resulting from those IT system changes.
We've come to the end of this episode of this series of EY videos on the implementation of IFRS 16. This is a summary of the key reminders and considerations for the first year of adoption of IFRS 16. Thank you for watching. I'm Emily Moll, and we will bring you more insights on IFRS 16 in our next episodes.